Really a mixed report here because the number of jobs created was weaker than expected, but the unemployment rate coming down to 3.9% was better than we were looking for at 3.9%. Your thoughts, Stephanie?
Well, the unemployment rate came down because the labor force shrank, so that's not a bullish indication. We want to see people obviously coming into the labor force and feeling positive about the employment backdrop. The other thing I would note is the 2.6 headline on the average hourly earnings, obviously a tick lower than expected. CPI is 2.4%. So in real terms, we're looking at almost zero real wage growth here. So that's going to act as a further constraint on consumer spending moving forward.
So it sounds like it's not as good as you would have expected.
It certainly wouldn't be reason for the Fed to move any more aggressively.
Yeah, Charles.
Yeah, I agree. I mean, this is you have a tale of two reports here. One certainly will make the market happy. This won't move the needle with the Fed. By the way, I'm still trying to figure out, maybe one of our experts will tell us what symmetric inflation is anyway. And then once we get past that, but I like the goods producing. Construction 17,000, manufacturing 24,000, mining 8,000. Those are the kind of folks who just have been left out for a long time. So I always cheer when they get a chance to get a piece of this prosperity. But overall, I thought it was going to be a higher number. It was just sort of plodding along. No need for the Fed, though, to take any action that I can see.
And I think that's the story here. The Fed is going to look at this and say, no need to even talk about 3 more this year. It's 2 more this year. And that's probably going to make markets happy, actually, because they do get nervous about the wage number. The wage number here is totally unimpressive. 2.6, less than expected, nowhere near the level that you'd really want to see with more people getting more money in their pockets. So this is probably market's going to like it, but not a great report from the standpoint of the health of labor markets. And I agree, the 3.9 number does not tell us things are necessarily getting a lot better. Right. It means people are dropping out of the labor force.
One area to look at is the services producing jobs, Dagan. That's where the job creation was. We're a services economy. No surprise there, but that's where the bulk of the hiring was, followed by the goods producing at 49,000. That's where really you saw jobs.
Manufacturing actually came in a little bit better than expected at 24,000 jobs added. The expectation there was for 20,000. So again, if you look at construction, to your point, it was one of the wettest months on record, but we still had an add of 17,000 jobs in the construction industry.
So you would have expected not a great number there just because the weather was so bad, and construction maybe slows down when the weather's not bad.
But
like you say, it's actually not a bad number.
That's better than the ADP number.
She's saying it's a better than expected number for sure. Danielle, your reaction?
I was expecting a little bit of weakness coming into the report because we saw both in the manufacturing ISM number and in the services manufacturing services survey, yesterday, we saw that employment had dropped to the lowest level since April of 2017. And there was also some weakness in services in the ADP report that came out earlier this week, in addition to what all of the guests are talking about, which is obviously layoffs in certain sectors of the economy. Those Toys R Us layoffs are starting to percolate through in these numbers, I think. So I think the little dip off of what was expected is what we knew about it in advance, but I would also point to those revisions not being near as strong as you would have liked. You would have liked to have seen March revised up much more strongly.
Yeah, that's a good point. John Hilsenrath, your reaction?
Well, we're throwing a lot of numbers around out here. I think the one number that everyone needs to pay a lot of attention to is that 3.9% unemployment rate. Employment growth is fine right now. When you look at it over the last 3 months, it's basically right in line with where it's been for several years. A 3.9% unemployment rate means that our job market is increasingly squeezed. Labor is becoming more scarce. We're not seeing it now in wages, but we are seeing pressures build anecdotally. For the Fed, that means that they're going to do 2 more interest rate increases this year, certainly. And there's a possibility, if that unemployment rate keeps falling, they go to 3.
But, John, wouldn't they, again, to Stephanie's point, that unemployment rate fell because nearly 250,000 people dropped out of the labor force? Well, the labor participation rate actually fell slightly, 0.1%.
You expect that kind of thing to happen when you have an aging population and baby boomers retiring. What matters for the Fed in terms of wages and inflation is, are we seeing more price and wage pressures building? And the lower that unemployment rate gets, regardless of why it's getting low, the more pressure we have. Labor squeeze is the term that I would use when we see an unemployment rate under 4%.
But that wage growth number was at 2.6%.
Right.
Yeah, that's
And
right.
that's one of the, that's one of the puzzles, you know, and I think that's what business, the thing they're wrestling with right now is they're seeing input price pressures, and can they pass it on? How much can they hold this off? Can they pass it on to consumers? And how much can they hold off wage increases for their workers?
See, I think it's still a question. I don't see the Fed getting aggressive here. I just, because the economy, while it is showing growth, is not gangbuster. And, you know, the biggest risk to this market may very well be the Federal Reserve just overstepping.
Well, also, the corporate bond market is already tightening. So regardless of what the Fed's doing in the background, you've seen on the back of the increase in Treasury yields, et cetera, a huge backup in high yield and investment grade bonds. And there's $1 trillion in debt that needs to roll this year in the corporate market that no one's talking about, that's going to roll at substantially higher rates. That's going to be another drag on.
Dagan's been talking about the supply out there.
I read Stephanie's research. Because when Stephanie is on, I actually we both take notes.
Yeah, and Scott Minerd mentioned that earlier this week when we spoke with him
He did.
at the Milken Conference. Joni Courtney, your take on where the job creation was and where the opportunities are today in the economy?
Well, you know, I can tell you, Maria, at EmployBridge, and we do a tremendous amount of staffing in the supply chain world, you know, there is a strong demand for manufacturing and logistics and transportation. So I continue to see that there are more jobs out there than we can find good talent. And the two things that probably concern me in the report are that labor participation did decline because less people are participating in the workforce. We need to get more people participating. And the other thing that concerns me is really the skills shortage, not having the skilled talent to meet those jobs. And I will tell you, I was on the phone this week with HR executives at Toys R Us, talking to them about how we can help take their workforce and find them work. And they're telling me that those people are finding jobs. So we are partnering with them, trying to help them find jobs, but they're saying it is a very good job market. So I'm surprised the number wasn't stronger.